Hi, I'm Shae Smith, Weekend Editor of Money Morning and Tech Insider. Over the past 3 videos, I've introduced you to technical analysis and some basic techniques, including trend lines, support and resistance, and Fibonacci. Now, I'll show you how to use those techniques to determine a level to enter a position and when to exit. As I explained in the second video, when moving averages cross over, traders use this as a signal to enter a trade. So let's look at a chart to see what I mean. As you can see, the price is in a downward trend. However, our 2 moving averages have crossed over. This signals that the trend may be about to reverse, that is, trend upwards. This means you would use this signal from your analysis to enter the trade. However, to also confirm that the trend is changing direction, you can apply an indicator. When a MACD is applied, we can see that the price and now the indicator have diverged. This divergence is another confirmation that the trend is about to reverse. So how do you decide at what price to open a position? This is where you apply your trend lines, the support and resistance lines I explained in the first video. See the support line below? Ideally, you want to maximize your profits. So you should try to enter the trade when the price is nearing the support line. However, before you enter any trade, you should always determine your exit position. Using the resistance lines as a guide, where the price reaches the top of the resistance line, is often a good price guide to determine an exit point. If the price hasn't previously broken through the resistance line, then you may place your take profit order just below the resistance line. You can then just sit back and watch the market. But this isn't always practical. And quite frankly, watching every market tick isn't only boring, but it can make you edgy and cause you to either sell out too quickly or take on unnecessary risk. This is where using conditional orders can be useful. When you enter a trade, you can do so there and then when the market is open. Basically, when you do that, it means you're buying at the prevailing market price. Alternatively, you can use conditional orders. This means that you can open your position at your predetermined price and at the same time set an exit price. This is a fantastic management tool. So how do conditional orders work? First, you need to have all your price data available. Your initial entry price, a profit target, and finally a stop loss. Let's look at an example. At the top, I'm placing an order to buy 100 BHP shares at a price of $36.81. I then place some conditions on the order. Next, you can see that I have set a stop loss of $35.78, followed by a take profit of $37.86. If either your stop loss or take profit is triggered, it will activate one of the orders and automatically cancel the other. This is often known as one cancels other, or OCO. Also, it's worth noting I have made all the orders good till cancelled. By doing this, I'm simply saying that I would like the order to be filled at any time BHP trades at this price, whether that's today, tomorrow, or next week. It's important to note that most providers don't hold these orders indefinitely. Markets are constantly changing. Even though you are placing orders with a good until cancelled condition, they may only be active for 30 days. If the order hasn't been filled in this period, it then drops out of the system. However, make sure you check the good until cancelled terms with your provider. That's all we have time for today. In tomorrow's final video on technical analysis, I'll go through some money management ideas using technical analysis. See you then.